Hello, everyone. Welcome to video one of chapter 8. We're going to be discussing capital gains and capital losses. For this first video, I want to be going through sort of the basic ideas, the basic concepts of capital gains before we get into any difficult calculations. I'm hoping to go through a handful of slides and then we will do exercise 8-1, talking about the basics of gains and losses. So capital gains and losses, we've in tax one, we discussed income from employment, business, and property. The thing about capital gains and allowable capital losses is they're not a source of income. The key detail about capital gains is they are incidental to our intentions. If I purchase something with the intention of selling it again at a higher value, and to make money on that, that's not really capital, that's inventory. When we buy something, usually we have a primary use for it. So if I had a machine that, manufactured barbells, the machine's use is to produce these barbells. These barbells are my inventory. I'm going to sell them. My intended use for this machine is production. But when I sell the machine, if I want to get a different one or a new one or just close my business, if I sell the machine for more than I paid for it, I have an income, and this income is incidental to my intention. So I want to emphasize that capital gains are often the result of incidental value increases that weren't my intention for purpose or for purchase. So it's not a source of income, and instead it comes from a disposition of property. Now, property can be depreciable, non-depreciable, or personal, and we'll go through that in a second. So I've mentioned that if I buy something for the purpose of selling it again, that is inventory, that is business income. Now, depreciable property can be owned by a business. It can be for property income. If I own a rental house, that is a depreciable property income item. And maybe I have some office furniture, maybe some computer equipment for my employment. So depreciable can follow into any of these things. Now, depreciable items are expected to lose value. So if I sell a depreciable item for more than I paid for it, I have a capital gain. If you remember from chapter 5 in tax 1, the thing about depreciable items is they don't have capital losses. Disposals, because they're expected to go down in value, disposals of depreciable property are usually handled with recapture or terminal loss. So depreciable property can have capital gains, but it can't have capital losses. Non-depreciable property is not always expected to lose value. Non-depreciable property is usually share stocks and land. Those are the two biggest examples of non-depreciable. So if you sell land for less than you paid for it, that will confer a capital loss. For personal, we don't usually consider personal a source of income. If I buy a car to drive it, it's expected it's going to lose value. If I sell that car for less than I paid for it, great. That's not a capital loss. It lost value because of my use. So personal items don't usually convey capital gains, capital losses, but they can. And we'll discuss personal use property and listed personal property later in the chapter. So from inventory, inventory can't have capital gains or losses. It's a business item. So if I sell something for more, that's income. That's business income or business loss, but it's not capital in nature, so it can't confer capital gains and losses. I discussed depreciable can have capital gains, but not losses. Non-depreciable can have both. And personal items can have capital gains or capital losses. The thing about personal is those capital losses can only apply against other personal capital gains, and specifically for listed personal property. Again, that is a topic we will cover closer to the end of this chapter, but I want to emphasize that although personal can have capital losses, they can only apply against other realized capital gains. So, a brief history of capital gains and losses. Right now, capital gains has what's called an inclusion rate, and it's an inclusion rate of 50%. So, if I have a $10,000 capital gain, my taxable income is only considered to have grown by $5,000, 50% of the gain. That is why we emphasize the difference between a capital and a taxable capital. Always look for that first word. When discussing capital gains, we're usually discussing the full realized amount. When discussing taxable capital gains, we're talking about the amount after that 50% inclusion rate. For losses, we have capital losses and we have allowable capital losses. So capital losses is the full amount. Allowable is talking about after that 50% inclusion. So always keep an eye out for those two prefaced words. Now, it hasn't always been 50%. It started at 50% when these rules came in 1972. At some point, it went to two-thirds, then three-quarters, two-thirds again. And there's been some discussion in the recent years, in 2024, of perhaps adjusting capital gains over a certain amount back to that two-thirds number. I don't think that proposed rule hasn't gone into place. We are still sitting at 50%. But the point being is it's 50% now, but it hasn't always been 50%, and it might change again in the future. So it's always good to be up to date with those rules. But all of our calculations in this chapter for your purposes are going to use that 50% inclusion rate. This is the proposed only for the two-thirds for over 250,000. I'm not going to emphasize this right now. Just focus on that 50% inclusion. We're not going to complicate it. Yes, so capital gains occur whenever the sales price is more than the cost, right? If you're usually when we talk about the sales price, we're talking about proceeds. Proceeds is the dollar value you have received when selling something. So if you've received more than its cost, you have a gain. If you received less than its cost, you have a loss, right? So we always want to consider that only 50% of either is used in our net income calculation. The Income Tax Act applies a concept referred to as a beneficial owner. The beneficial owner is considered the real owner. So we have a person who has ownership rights. So let's say I own a house, but if the risk of the property or the legal liability, basically, if the benefit of that property is going to someone else, then they're considered sort of the ownership of the capital gains and loss. So what this means is if I buy a house and it's being rented, but that income's going to a family member, then you can't sort of hide from those capital gains or losses by hiding it under someone else's name. So the legal owner is the person with legal title. A disposition excludes a transfer of property where there's no change in beneficial ownership. So disposition's talking about when we talk about the beneficial owner, if it changes hands, if the beneficial owner has not changed. So let's say I have a business and my business has two separate divisions. I have a manufacturing and a distribution. If I move it from my manufacturing to my distribution center, this asset, this building, the owner hasn't really changed. Despite its change in use, the beneficial ownership of the property has not changed, so we don't need to consider disposition. We do consider dispositions anytime there's a transaction that changes the entitlement to a different person. So if I sell my building to someone else, I have disposed of it, is what it's saying. If I have shares and I redeem those shares, so I didn't sell them, but I gave them back to the company and they gave me money, that's a disposition. Bonds are basically loans. If I have a loan and it matures and the company pays me back the money for that loan, I've disposed that loan. So if I got more than I paid for it, or if someone else likes the interest rate and they buy the bond from me, if they pay me more than I paid for it, that's a capital gain. The things that we want to talk about down here is gifts, thefts, destruction, certain events for deemed dispositions. When we have redemption of shares and bond maturities and sales, those are really easy to recognize the disposition because usually cash or something else of value is exchanged. I received cash. I received $100,000. Of course, I sold it. Those are my proceeds. But it's not always clear when money hasn't been exchanged. If I give something, if I have an asset and I give it away, that's a deemed disposition. So, what a deemed disposition does is it recognizes the change in value up to when I no longer had it. So, if I had these shares and I bought them for $10 and they went to 15, my value went up $5 for every share. So if I give those shares away, I have to recognize the change in their value while I owned them. So they will deem to have been sold at 15, so I can recognize that change in value on my taxes. The person I gave the shares to, their cost will be the $15 that's been recognized, and any change in value after that will be taxed in their hands. So deemed dispositions are usually trying to find this cutoff between how much value changed in someone's possession. If something gets stolen or if it's destroyed, it's considered a disposition, but my proceeds are zero. I sold or got rid of it, but I didn't receive any cash. So thefts and destructions often result in capital losses. There's also certain events that result in deemed dispositions. This is so how tax work, as long as I'm a Canadian resident, all of my income is taxed here. But if I break that residency and move to another country, I've changed my status. Now, since I'm no longer a resident, all of my income is no longer taxed in Canada. So we deem the disposition. We're going to recognize the change in value while in Canada, and then any further value changes will be taxed in your new country. So deemed disposition. So that's an example of an event. When it comes, does it go into residency stuff? Share issuance, does it go into proceeds disposition? I don't know if it goes into the details, but I'll say this. When we break, because if you are a non-resident, Canadian source income is still taxed. So if I have Canadian property, if I own Canadian land, and I have some Canadian shares in a corporation, when I break residency, the change in shares will be deemed disposed, but the Canadian property that is here won't be deemed to be disposed. So that deemed disposition. So what that means is so not everything is going to be considered disposed of and taxed. Really, only the assets that are going to go with me will be considered to be deemed disposed. So those shares, even though they're shares of a Canadian company, that value change is going to be in the shares I hold in the other country. Those shares are coming with me. But land can't move. So Canadian property that's stuck here won't be disposed of until I actually sell it off. Okay, so property transfer for collateral security. So if I default on a loan and they take my house and it just covers the remaining balance, that will be my proceeds. Share issuance by a corporation, issuance of bonds and other debts. So, share issuance is the opposite of the redemption. I'll give the corporation money, $10. They will give me a share. My cost is now $10. An event that causes deemed disposition generally treats the property. Yeah, so whenever we have a deemed disposition, it's always considered to be disposed of at its current market value on that date, also known as its fair market value. So your fair market value is considered to be the proceeds received. So proceeds is the sale price of the property that's been sold, includes compensation received from insurance company. So if I have a building that caught fire and the insurance company pays me out for that destruction, those insurance proceeds will be my proceeds of disposition. If it wasn't insured, then my proceeds are zero. If it was insured, then those proceeds are whatever dollar amount I received. And the deemed fair market value is also considered to be the proceeds on disposition. So you'll see pod a lot. We'll talk about proceeds pod. So you'll see pod in our exercises. That's always we're talking about the cash received or the deemed proceeds amount. The cost you pay for something, it's called the adjusted cost base, represents the cost of property sold. For depreciable property, the adjusted cost base is also its capital cost. For non-depreciable property and personal, ACB is cost plus specific adjustments. We'll get into what those adjustments are. But generally, when we say ACB, that's its adjusted cost base. We're usually referring to the just the cost value of an asset. A stock option benefit received by an employee, which we'll go into this. Stock option benefits usually allow employees to get a discount of stock. The share's worth $18. I buy it for 15. It cost me $15, but I got $18 of value. That $3 difference is included in income as employment income. So because I'm recognizing that value as income, my adjusted cost base is the 18. So capital gains and losses are calculated by that fair market value 18. It only cost me $15, but my adjusted cost base is $18. That $3 difference is employment income. Anything else is going to be capital gain. Hopefully you all remember that from chapter 4, I think, from last taxation course. When we sell something, sometimes there are certain costs. So when I sell a house, let's say I sold my house for $300,000, there's usually outlying costs. We have to pay a lawyer to handle the transfer of the deed, basically. We have to pay commission to our real estate agent if they helped us sell the house. So these fees directly related to the sale of the asset or the capital item get subtracted from the proceeds received. So I sold it for 300,000, I received 300,000, 5,000 went to the lawyer, 15,000 went to the real estate agent, so I paid out 20,000. So I got 300, paid 20, so really I received 280,000. So our proceeds are usually allowed to reduce based on our outlays. So that also reduces our capital gain or increases a capital loss, right? So we have fixing up expenses, finder fees, legal fees, and transfer taxes are usually the biggest ones. When we have stock and share purchases and sales, sometimes if we're using a broker, they'll take a certain commission. So that will be subtracted from our gain loss as well. Okay, I got a handful more slides where we actually talk about the calculations. Then I'll go into the exercise. I'm not sure how long we've been at. I forgot to set, usually I have a timer going. I forgot to set my timer. So let's just go through this as quickly as we can, get this first video out of the way. Capital gain is always what cash I received, my proceeds, minus my cost. If my proceeds are more than my cost, I have a positive number. I have a gain. If it's below my cost, that's going to result in a negative number, a loss. From my cost, I can add my outlays and expenses. So your outlays and expenses either add to the cost or subtract from your proceeds. It's going to come to the same result. So I usually tend to subtract outlays from my proceeds, but you can do it either way. Add it to the cost, subtract from proceeds. So an example of a capital gain is vacant land sold for $86,000, but we bought it the year before for 30. So the difference of that is $56,000. So we're starting with a $56,000 capital gain. 86, our proceeds, minus our $30,000 cost. Interest on money borrowed to acquire the land and property and taxes was $11,000. Outlays and expenses was $9,200. So that brings us, so our 86,000. Oh, sorry, yeah. So our 86,000 is what we started. Our adjusted cost base is $41,000. It's the 30,000 that we paid for it, plus that $11,000 on interest borrowed. And then we have an additional $9,200 of expenses related to disposition. So our total cost is $50,200. So our total capital gain is $35,800. So that's our capital gain. Are we looking for our capital gain? No, we're going to be looking for our taxable capital gain, which means we need to use that 50% inclusion rate, which is half. So 35,800, half of which is 17,900. So our taxable capital gain, we got $86,000. Our taxable capital gain, the amount included in our income, will be 17,900. If we did this the other way, our ACB, our adjusted cost base, is still going to be 41,000, but we sold it for 36,000. So we sold it for less, and we still have our outlays and expenses of another 9,200. So 36,000 minus our 50,200, that gives us a negative number. We have a capital loss. Our inclusion rate's 50%, which brings us to our allowable capital loss. That's going to be 7,100. So we lost $7,100. The thing about capital gain, taxable capital gains are always included in income. Allowable capital losses can only subtract from your income if you have capital gains. So Tax Act, so we have the 40, 39, 38 rule. I'm going to go through this quickly. I don't think we test you on this specifically. It's just kind of understand what the Tax Act doing. So Income Tax Act 40 discusses the calculation related to gain or loss and the how disposition's treated. This contains the basic calculation saying proceeds minus cost minus expenses and outlays. Tax Act 39 has specific rules that prevent capital gains or losses on inventory. Basically, it's the tax rules saying inventory is a business item. It can't have gains or losses. Capital losses on depreciable property. There are no capital losses on depreciable property. That's handled with terminal loss and recapture. So we always look for taxable and allowable. These are the amounts that are after the 50% inclusion. All right, I'm not going to go into superficial loss. I will save that for the next video. Let's go to, golly, you know what? Our video is getting really long, so should I stop it or should I just go? I guess we'll just go. Let's just go for it. So here we have 9 cases, and I'm going to try to quickly go through and give you the quick rundown of how do we treat this. Years ago, I purchased a painting by a Canadian wildlife artist for $1,200. It's in my home. Recently, I sold it for $4,900. I sold it for more than I paid for it. That's a capital gain. So even though it's personal property, it has an incident. It was just it was decor in my house, but there's an incidental increase in value. So I'm going to recognize that as a capital gain. 2 is the same as 1, except instead of my home, it's hanging in the walls. It's hanging on the walls of my office space that I own. The partnership wanted to change the selection and sold the painting for $900. So if it was a personal painting, its drop in value could not be realized as a capital loss. Because it's now an office decor related to my business, that drop in value could be a capital loss if it's considered a non-depreciable asset. If it is considered depreciable, then there's no capital loss. We'll sort that out with recapture. And just to show what that looks like here, one second. Meant to have this open before I started, but here we are. So painting in home has a taxable capital gain. Painting in business, if it's non-depreciable, we'll have allowable capital loss of $1,500. We have a $300 loss of value. Half of that is $150. If it's depreciable, there's no capital loss. Case 3, you have a custom-built home. You purchased the plot of land for $30,000 and spoke to the contractor, but before arrangements could be made, my work transferred me to another province. I had to sell the land at a loss. I lost $7,000. Bought it for 30, sold it for 23. So what about this loss? Well, this loss is personal. I bought this land for my personal use. I was going to build a home, so this loss cannot be recognized. If I bought the plot of land with the intention of selling it after getting a tip that the municipality was going to be rezoning and that it's going to increase in value, but I later learned the rezoning was not passed, so I sell the land for 23,000. So this changes our intention. Our first intention was personal. We lost, no capital loss. Our second is we bought this to sell. So it's not a capital item, it's an inventory item. This is called an adventure in business or an adventure in the nature of business. So I bought something with the intention of selling it as inventory. Because of its business function, this loss will be considered a business loss and I can subtract the full $7,000. You're assessing your investment portfolio. Your advisor says you should include some real estate. As a result, we purchased land for $30,000, expecting it to increase in value. 6 months later, turns out the water level's not good for humans. The real estate value drops. We cut our loss, sell for 23,000. Now it's capital in nature. Its increase or decrease in value wasn't the intention. I bought some land for the purpose of investment. Perhaps I was hoping to rent it out or eventually build something for a rental property. Because I had it for investment purchases, its increase and decrease is likely to be capital in nature, incidental to my function. Because it's land, it's non-depreciable, so I can recognize the allowable capital loss. So cases 3, 4, and 5 are related. The personal function, there's no capital loss. For land for resale, this is inventory. The whole $7,000 would be a business loss. Land for investment, it's non-depreciable, so we can recognize the capital loss, and the allowable capital loss of $3,500 could be included in income if we have gains to apply it to. The next couple cases relate to a printing press. You carry you carry on a printing business as a sole proprietor. A printing press I bought 4 years ago cost $40,000 and was sold for 11. They talk about the UCC of the class of $21,000 and a replacement printing press was purchased. So we bought it for 40, sold it for 11, so there's no capital gain. There's no capital gain. We sold it for less than our cost. This printing press was used. It's a depreciable item. They give us a UCC amount for it. So because it's depreciable, there's no capital loss. It will be dealt with recapture and terminal loss. So for us, printing press, it's depreciable, no capital loss, CCA disposal rules. Land for resale, you carry on a business. Oh no, that should be land of resale. Sorry, antique desk. Let me just change that quickly. So antique desk. We sell antiques through a store situated in a building we lease. We sold an antique desk that a buyer paid 10,000. Desk cost us 17. So this is the same thing. That desk is inventory. We bought it for 17. We sold it at a loss. It is a business loss. It will be wholly included in income. Inventory 7,000, just like the inventory for the land. That's why I think I had them mixed up. Now we have case 8. Now case 8 has 2 items associated with it. You carry on a computer service and supplies business. We own the buildings. You decide to close one of our 3 buildings. The property originally cost 660,000. We sold it for 700,000. Oops. So the thing about this sale is there's 2 parts of it. We're selling building and land together. So we need to allocate how much of the transaction was for land, how much was for building. So at first, $100,000 of the purchase price is for land, and then $80,000 of the sales price was for land. Yes, so we have this case 8 has 2 transactions. The building sold, the land sold. So our total amount, 660,000 was our original cost. $100,000 was associated with the land. It says that of the proceeds, 80,000 was associated with the land. So we have 80, cost was 100. We have a capital loss of 20,000. Our allowable capital loss will be half of that, 10. I hope I'm not going too fast for you on this, but good thing about videos is you can backtrack if you feel you need to listen to it again. In the question, we allocate out 100,000 for land of the purchase and 80,000 for land from the proceeds. So our proceeds were 80,000, cost was 100,000, capital loss is 20. Of the depreciable building, the cost associated with the building was 560, and we sold it for 620. That's a $60,000 gain. Taxable capital gain is 30,000. Allowable capital loss is 10,000. So remember, we have those key words, taxable and allowable. Since we have both a gain and a loss, we can net them, and this creates what's called a net capital gains of $20,000. So we're taking our taxable capital, we're subtracting our allowable losses. So of this transaction, our net capital gain that's going to be included in income is $20,000. All right, our last case. You recently purchased shares in a startup. We paid $17,000. 2 months later, it turns out the technology wouldn't work, so we ended up having to sell our shares at cost for $17,000. Great for us. We bought it for 17, we sold it for 17. We're even. Except we incurred selling costs of $1,000. So we got 17,000, but we weren't able to keep 17,000. Really, we got 16. 17 minus our cost, we got $16,000. So that's actually a loss. We have our total proceeds minus our selling costs minus our actual costs is a capital loss of $1,000. So an allowable capital loss is allowed of $500, 50%. Okay. Yeah, so that's the basics. Going through these calculations, I know this video is a little longer than I hoped it would be, but hopefully we've laid the foundation and the groundwork that we can move forward at speed. If you have any questions, feel free to review Professor Mackenzie's lectures. Hope maybe that might give you another perspective, but you can always email me and I'll answer questions as best I can. Thank you for your time. I will see you in the next video.